In this tutorial, I'll be going through with you Blackstone Group Inc. You can see this from Google. Just type it in Google, and you can see the name here, full name, and the you can see the symbol as well. It's BX in Nasdaq, and if you buy stock right now, it's 46.62 US dollars on 2nd of August, and now I just want to say that this company is in billions, market cap is in billions, which means it's a big size firm. It's paying a dividend of 4.44%. That means that any company that is paying dividend, that means they're financially very strong, and after paying their creditors, loans, liabilities, they still have extra money. That means they're financially very strong, and that's brilliant. And let's go to Wikipedia and see that when was this founded. I can see in 1985, 35 years ago, and I want to see what the employees think about this firm. So what I'll do is I'll just copy this whole part and I'll paste it in Google and type in Indeed reviews, and I can just see that it's 132 reviews, 3.8 star. That's brilliant. So you can just read through the pros and cons yourself, the salaries it's paying, the question answers, the jobs it's listed, and then read through the Glassdoor reviews as well. So please read through the reviews, and it's 208 stars, 3.6 star, and that's brilliant. And please read through the pros and cons yourself, the jobs it's listed, the salaries it's paying, the interview questions, the benefits it's giving, and everything. Now let's go to Justia Patents and see if it has any patents. I'll just click there, click enter, and I just want to explain you briefly that please don't concentrate on inventors, because these are people who invented but they don't have full rights. Please concentrate on assignee or applicant, because these are people who have full rights. And so you can see that in 1993 it has a patent. 1993 it has a patent, and then in 1993 again it has a no, that's a different firm altogether. You could just paste it in Google and see. Yes, that's a different firm altogether, so that's not the one we're considering. So you know, be careful with the names as well. So it has only one patent in 2006. That's brilliant, and that's it. And so go through the list yourself and see if it has any more patents or not. And so that's brilliant. So the more patents a firm has, the more stronger it is in the market. And so be careful with the names. And that's the patent in 2006 it has, and stuff like that. Now let's see Yahoo Finance and see if it has key executives that have shown all their salaries or not. So I'll just paste it in Google, and I'll click the symbol BX and go to profile, and I can see finance, the sector, industry, and employees. And the best part is that all of their key executives have shown their salaries. They haven't hidden anything from us. That's brilliant, because it builds trust, and it's more easy to build trust with these people because they have shown all their salaries. That's brilliant. Now let's go to macro trend and see the ratios. Let's click price ratio, price book ratio, and I'll just paste in the symbol. So I'll just see the symbol in Nasdaq from Google, and I can see the symbol is BX, and I'll just search in BX here, click this one, and if the ratio is less than 1, that means that the stock is cheap, it's undervalued, it's at discount, it's ideal time to buy. If it's less than 1, if it's more than 1, that means stock is expensive. The higher the number goes, the more expensive it gets. Right now it's 2.21, which means if somebody buys a stock right now, they'll be paying 2.21 times more money. It's more expensive. But if somebody bought in 2018, they paid 1.66 times more money. So if you just see vertically up, if somebody bought in September 2018, they paid $35 to buy something that was only $21 worth. So but right now it's 2.21 times more expensive. If you see in 2008 December, it's at discount, it's 85% discount. So it's somebody who bought in 2008, they bought it for they paid $3.4 to buy something that was only $21 worth. So they got 85% discount. So it was very cheap in 2008 December. Right now it's 2.21 times expensive. Let's go to other ratios and look at current ratio. If the ratio is less than 1, that means stock is risky because liabilities are more than assets. If the current ratio is 1.5 or more than that, that means stock is safe. And right now it's less than 1, that means stock is risky because it's less than 1 and liabilities are more than assets. And so let's look at the previous trend. Has it ever been 1.5 or more than that? No. So we have data since 2007 up till now, and Since 2007 up till now, it's always a risky stock. It's always below 1.5, and it's a very risky stock. And let's go to debt equity ratio, and let's see if it's mainly operating on debt or equity. We are looking for zero point 0.5 or less than that. Right now, it's um, more than zero point 0.5, so it's a risky stock in terms of debt. And the previous trends as well, it's always like from 2010 March up till now, it's always been above zero point 0.5. It's a very risky stock in terms of debt. Let's go to return on equity. We are looking for 8% or more than that. Right now it's more than 8%. And let's see the previous trends. So it's since 2016 December up to now, recent 3 years, it's always been above 8%, but before that it was less than 8%, and even a minus equity. So since recent 3 years, it's 8% or more than that.